So far in the S&P 500, we are seeing a lot of red right across the board, yet when we take a look at the Fear and Greed Index, we are still sitting well within greed at a score of 64, and do understand we do have earnings season going on. Disney did just report before the market opened today. We have Alibaba reporting before the market opened on Friday, and then the big one the whole market is looking forward to next week sees Nvidia report their earnings. Now, very briefly, Disney did report, as we mentioned, and it was a very strong one. Good news for shareholders. They beat in terms of their top line as well as their earnings per share, and they have said they expect high single-digit EPS growth in comparison to the previous year. One of the better news, as we can see, their streaming network was up 14% on a year-on-year comparative. And when we take a look at the actual numbers, we can in fact see earnings per share 114, better than the 110 the market wanted, and the top line revenue 22.57 versus the 22.45. Now, we're not talking about Disney today, but we just wanted to highlight you their earnings as it was from before the market opened, and we can see the market did like that. It is up around 7%, currently trading around the $110 mark. Now, under the spotlight today, we are talking about 5 undervalued dividend stocks with some very nice upside over the next 12 months. We're going to run through each one, which does trade around its 52-week low, and the first one is Merck & Co. We can see they are down around 3.5% over the last 12 months. Over the last 10 years, though, they are up around 66%, and as we can see, 52-week low with a buy rating from Wall Street that is at 4.41, needs to sit at 4.5 to turn this into a strong buy signal. So as we can see, very bullish. Seeking Alpha though and Quant do give this company a hold, and with a forward P sitting around 12.6, bear in mind S&P for those that want to know around 26 itself. Forward yield around 3.13%, so actually pretty strong in terms of a starting position. And whilst we're not doing a deeper dive on this company, we just want to flag that the valuation score is an A+, the growth is an A, and the profitability is also an A+, not something that we typically see in terms of A's all across the board. And then when we take a look at their earnings, we can see over the next 4 quarters, they are expecting each one to be strong growth on the year-on-year comparative. And when we look from their historical forecasting accuracy, 100% track record, at a minimum, they have been in line. In fact, 3 of the last 4 have been quite substantial beats. We also notice for the next full year, December 2025, EPS growth to 951, which will in turn lower that forward P to 10.36. In terms of dividend safety, very good to see, 90 score, very safe. We'll cover these 2 models very shortly. And last November, in fact, an above inflationary increase at 5.5%. That tells us we are probably days away from hearing about their increase for 2024. Now, it was reaffirmed literally today, their very safe signal, which ultimately means a dividend cut for MRK is highly unlikely. Now, each one will touch upon some key metrics from the last recession, 07-09. Merck & Co. maintained the dividend, didn't increase, didn't also cut it. -4% recession sales, above the S&P's -12, but we do know they had a near S&P return, -57, S&P itself -55. As we mentioned, 5.5% last November, 9% over the last 5 years, and at the bare minimum, over the last 20 years, they have been increasing those dividends in line with inflation at 4%. Remember, US inflation rate on average over the last 40 years has been 4%, hence why we do keep mentioning that. 12 years of continually increasing the dividend, with 53 years of paying a dividend without a reduction. Now, when we take a look at this valuation model over the last 12 months, we actually see it quite a bit trading overvalued. Right now, we see it heading towards the lower end of the expected fair price. That is why we got that undervaluation signal. But remember, we don't look at any one of these models in isolation. We will conclude towards the end of the episode. Dividend yield theory, as always, tells us when a company is undervalued with the current yield above the 5-year, which is what we get here, 3.12 above the 5-year rolling of 2.96. Forward P as well, 10.9, lower than the 5-year 13.7. This is what we'd say is a double undervaluation signal. On top of that, Merck & Co. does trade below the healthcare sector of 16.7, in turn telling us it is trading at a discount to the overall sector. Is it one that deserves to be trading at that discount, or has the market overreacted? Something we will get to in our own valuation. Now, free cash flow, as always, below 60% is our target, as we typically don't look at earnings, which is susceptible to manipulation by management through accounting. Now, very inconsistent on a year-on-year basis. In fact, 81% in 2023. The fact that on a trailing 12-month and over the next 12 months, it is anticipated to come down quite sharply, does give us some positive faith that this month we should see a very, very attractive dividend increase. Then we move to the free cash flow per share, where we want consistent increases over the longer term. We don't get the consistency, but we do get the increase, $2 2014, $3.60 in 2023. Great to see over the next 12 months, anticipated to go up to $8.24. Then we get to sales growth, where we want that 3 to 7%, 3 to 4 at the bare minimum, just to keep up in line with inflation. Again, inconsistency, but the last 4 years have been okay, and 7% on a trailing 12 month does look good for the full year of 2024. In turn, then we look at their numerical format, 43 billion, so around a 50% growth from 2014 to 2023, 61 billion. Another metric we do look at are those shares outstanding, making sure companies return excess cash through those share buybacks. Not something we've seen them do consistently. Yes, it has decreased from 2014, but the movement since 2020 has been pretty stable, so probably not something they look at in terms of their capital allocation currently. And then we look at the ROIC, very good. One of our favorite metrics as well, not just above the minimum, going from 13% in 2014, 21 in 2023, 23 on a trailing 12 month. So we do like this a lot from MRK. And investors will also love to see this when they do consider adding this to their portfolio. Remember, for that metric, 10% or more, give us faith, management are able to effectively allocate their capital. We then move on to their margins, where we want to see efficiencies and above the minimum. We get both of them for MRK. 22% in 2014, 30% on a trailing 12-month basis, above the minimum 12% and increasing over the longer term. That is a very good signal, something we use to identify high quality companies. And the free cash flow margin, whilst not consistent, always above the minimum 5% and 24% on the trailing 12-month. We then move to the net debt to EBITDA. Below 3 is what we want to see. EBITDA referencing the earnings before interest, tax, depreciation, amortization. And the numbers below, as always, referencing the number of years it would take the company to pay off all of their debt net of cash on hand. And very key to understand, this correlates to dividend safety, balance sheet strength. So yes, it is below 3. That is a good sign. 2.81 in 2023, a large increase, but the fact it has come down already on a trailing 12 month and over the next 12 months is a good signal. We understand why we had that 90 very safe score, and the balance sheet in turn from this information does look strong. Now let's jump into the valuation of MRK. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now typically on this channel we do run through every single one of these models, talking about the inputs and the outputs. Today we're going to get straight to it. Intrinsically $132. Actually not far off Wall Street, their price target 133.44 over the next year, where they see upside of 36%. Now we do want to put a margin of safety for each company, where we start at 10%, execute on this if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today will buy up to $119, then we keep going till it's near the current trading price. And what we can in fact see right now, we believe MRK, Merck & Co, 25% MOS, with Wall Street indicating 36% upside over the next 12-month period. As always, give us your thoughts about these companies as we run through, whether you believe it is a buy, hold, or sell. We also want to let you know we have released our latest free weekly article. We drop one every single Monday morning to your inbox, where we talk about some severely undervalued stocks that deserve your attention, as well as what's gone on in the market over the last few days. So click below, sign up, and you can read straight away, where you'll also be able to gain access to 40 undervalued stocks for the month of November. Lots of information, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet with 22 undervalued stocks that Wall Street themselves believe have the most upside right now in the whole S&P 500. So as we said, click below, sign up, and you can read straight away. We then move on to Nike, where we can in fact see trading towards its 52-week lows, similar to the previous company, just a buy signal from Wall Street, with a forward yield just below 2%, a forward PE sitting around 27, and over the last 12 months, down 27%. They didn't have the greatest earnings, as we have previously covered on this channel. Over the last 10 years, up around 60%, and as we can see, all-time highs, November the 1st, 2021, just under $180. In fact, right now it is sitting around $100 less per share. So in terms of their earnings, as we can in fact see, the next 3 quarters, they're expecting double-digit decrease to the EPS, but historically over the last 4, they have significantly outperformed management's estimates, and in turn, over the next full year, May 2026, they believe the earnings per share will grow to $3.24, lowering the forward PE to 23.63. Now, similar to Merck & Co., we get a very safe dividend score. In fact, Nike having the highest one obtainable at 99, with a double severe undervaluation signal. And again, similar to Merck & Co., they increased their dividend in November at 8.8%, meaning we are expecting one to come over the next few days. Then we move on to essentially looking at the key metrics from the last recession. They increased the dividend above average growth, whilst also outperforming the S&P with a negative 36% return. On top of that, very good dividend growth, 11% on average over the last 5, 15% on average over the last 20 years, and they've been paying a dividend increasingly for the last 22. If they manage to keep this up over the next 3, they will in fact become a dividend aristocrat. So let's take a look at the PE ratio in terms of valuation, and over the last 12 months, in fact for the majority of it, they've been trading well below the bottom end of the fair price, and as we can see, this is a severe undervaluation signal, something that we also see when we come to both the dividend yield as well as the forward PE. 1.93 above 1.08, 26.7 below 31.9. However, we do note it is significantly higher than consumer discretionary's 14.7. In terms of the free cash flow payout, below 60%, which we can see for the majority of the last 10 years, although we do notice a massive increase over the next 12 months to 86%, something that we would say just keep an eye on moving forward. In terms of free cash flow per share, well, it has pretty much doubled from 2015 to 2024, although we do see a lot of inconsistency year on year, and we should flag over the next 12 months, this is expected to drop sharply down to 173 per share. In terms of the sales growth, well, as we already mentioned, they have been struggling over the more recent period, which is why we see it flat in 2024 with a drop on a trailing 12-month basis, indicating for their next full year, we are expecting sales to either be increasing very marginally or a marginal drop. From a numerical aspect though, it has been increasing over the longer term, and whilst they do share buybacks very inconsistently, not something, again, similar to Merck & Co. that management maybe have at the forefront in terms of what to do with their capital. ROIC, no issues whatsoever, very strong, very healthy. Again, yes, inconsistent, but not the worst when it is still above the minimum 10%, 22% on a trailing 12-month, still looking very solid. And with the operating margin, we don't get operating efficiency, so no increases over the longer term, but we do get it straddling around that minimum that we want to see. And the same to be said for the free cash flow, looking very healthy, 13% in 24, 15% on a trailing 12-month. In terms of net debt to EBITDA, a phenomenal balance sheet. No surprises why we get that 99 dividend safety as well. 0.27 over the next 12 months, so no worries with this aspect whatsoever. We then move on to the valuation, where as always you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for this company or any others. As we can see though, for this company, $98 intrinsic value. With the current price, there should be a nice MOS. At 10%, a buy at $88, at 15%, a buy at $84, at 20%, around $78, and in today's episode, not quite at the 25% MOS just yet, so sitting somewhere between 20 to 25. With Wall Street, over the next year, they believe these shares will rise to 93, giving it upside of 22%, and as we said, let us know, buy, hold, or sell. We then move on to Occidental Petroleum, where we actually get a triple hold right across the board. However, it is at its 52-week low with a yield of 1.72%, one of the lowest in the industry, and a forward PE just below 15. Over the last 12 months, well, down 18%. Over the last 10 years, down around 42%. but remember, will depend at which point you did buy shares. In fact, as we can see, that COVID drop around $10. If you did load the boat there, you would be up around 5 times at the current price of $50.65. In terms of their earnings, well, this industry is fairly cyclical, so 2 of the next 4 they're expecting double-digit increase, 2 of the 4 as well double-digit negative growth. However, having said that, they have outperformed some quarters actually quite significantly, 100% track record, with a marginal growth anticipated over the next 4-year accounts, lowering the forward P, although marginally, to 14.24. In terms of dividend safety, well, we get a 60 borderline safe. We'll run through these models, but very strong increase to the dividend, 22% in December last year. So next month we are expecting an announcement about some increases. In terms of dividend safety, now it was reaffirmed back end of August. What a borderline safe score means is that there is a moderate risk of a dividend cut over a full economic cycle. And when we look at their key metrics, we can see they actually increased the dividend, they had below average growth, and they also massively outperformed the S&P, negative 23% return. But we can see they have had some dividend cuts over the last few years, with over the last 20, it coming out at 2% increase year on year, and therefore they only have 2 years of consecutively increasing it. So moving on to the valuation, when we zoom into over the last 12 months, we actually see some part of the last year it's been trading massively overvalued. Right now though, we sit right at the top of the upper end, so this does signal overvaluation. When we look at dividend yield theory, actually it signals the opposite, massive undervaluation, yield at 1.74, the 5-year rolling at 0.88, although we do know the opposite to be said on the forward P, 14.9 versus 12.8, so a lot of contradictory evidence here. In terms of the sector P, well, pretty much Oxy is bang on that of the energy sector at 15.1. And when we look at the free cash flow payout, remember the industry cyclical, we expect this to sharpen the numbers. Below 40% is what we want for oil producers. We get that over the last few years, 15% over the next 12 months, so we do anticipate a nice double-digit increase in December this year. In terms of free cash flow, 2 of the last 10 years negative, and in the 2023 it's 679. We are anticipating over the next 12 months a drop to 584. In terms of sales growth, with the cyclicality now being shown, 5 of the last 10 years have actually been negative. Trailing 12-month, negative 7%, telling us pretty much we expect the same in 2024. And when we do zoom out, we can see that cyclicality in a numerical format, although from the lows of 2016, their top line has increased nearly 3-fold. What they've also done, the opposite of what we want to see, they have diluted your position as a shareholder, increasing the share count from 781 to 959 in the latest quarter. How about ROIC? Well, looking good when we do just focus on the last 3 years, 8% on a trailing 12-month. And when we do get to the margins, the same to be said, last 3 years have been good, above the minimum 12%, 21 on the operating side, and on the free cash flow side, 23% in 2023. So understand, with oil and gas, this is an industry similar in fact to semiconductors, where it is cyclical, and we will expect that to come out through the numbers. In terms of net debt to EBITDA, below 1.5 is what we want to see. We get that in 2023, although an increase above that on a trailing 12-month, marginal drop in terms of the next 12 months, so something we would advise just to keep an eye on, probably one of the reasons why we do see that lower dividend safety score than we would essentially like. In terms of the valuation, well, our intrinsic value at $67 will give more room for an MOS, 10% a buy at 61, 15% around 57, and we can see in today's episode for Occidental pretty much around a 25% MOS at the $50 to $51 mark, with Wall Street being bullish, their price target $64, indicating 25% upside over the next year. We then move on to one of my favorites, Coca-Cola FEMSA, where we do see it trading right now at its 52-week low. We have a double buy from Seeking Alpha and Wall Street with a hold from Quant. In terms of the yield, 3.21%. In terms of forward PE, just below 14. Now, over the last 12 months, down around 9%. Over the last 10 years, actually down around 24%. But we can see that COVID drop, it was trading below $40. Right now, pretty much double. In terms of their earnings, well, we do see, in fact, 3 of the next 4 quarters expecting a decrease, with the last 4 100% track record, and therefore they are anticipating the next full year to be growth, 658 earnings per share, lowering the forward P to 11.89. Now we do get a borderline safe score of 60. We'll cover these two models which seem to be contradictory, and they did over the last full year increase the dividend at 5%. So what does this mean, 60? Well, they just reaffirmed it just yesterday. So as we've mentioned, very similar in fact for the previous company, moderate risk of a dividend cut over a full economic cycle. Now they increased the dividend during the last recession. They had positive sales when, as we said, the recession was -12, and they outperformed the S&P -36, S&P -55. Over both the last 5 and the last 20 years, they have been rapidly increasing that dividend, 17% year on year over the last 20, although they only have 6 years of consecutively increasing the dividend, 20 years without a reduction. Now, in terms of the P ratio, when we do look at it over the last 12 months, we actually notice it's right at the lower end. In fact, it has fallen out of the blue intrinsic value tunnel, so that is a severe undervaluation signal. When we look at dividend yield theory, however, we get contradictory evidence, 1.85%, well below the 4.1, yet the forward P again telling us something different, an undervaluation, 13.4, below the 5-year rolling of 15.8, and we also notice much lower than consumer staples at 17.6. So in terms of the free cash flow payout, we do notice below 70% every single year, which is what we want. Nice drop to 24% over the next 12 months. So maybe we will get lucky with a nice double-digit increase for the next rise. And then we see the free cash flow per share. Whilst we don't see massive growth, nonetheless, it has increased moving forwards. And on a trailing 12-month basis, it has lowered to around 90.3. In terms of sales growth, around the 3 to 7% year on year, although we can see 3 of the last 10 have been negative. Last 3 years looking good, 11% on a trailing 12 month, also fairly positive. In terms of numericals though, we see it around 147 in 2014, 245, so it is moving in the right way. It is what we want to see with this company, but they have, although very marginally we would say, been diluting your position as a shareholder over the last 10 years. ROIC looking good, no complaints, above the minimum 12% if we want to be industry specific, 12 in 2014, 16 in 23, and on a trailing 12 month. And then we move on to the margins where it is very consistent around the 14-15% level, and the same to be said for the free cash flow, no red indicators that we do see today. In terms of net debt to EBITDA, one of the things we love, we say below 4 for consumer staples. In fact, from the peak of 2016, 2.36, it has been coming down, 0.74 on a trailing 12 month, expected to be there or thereabouts over the next 12. So we actually believe, even though we got the borderline safe score, this isn't one that we have any issues with. Great balance sheet, and we believe the dividend does look to be safe. Now, our intrinsic value of $127 is significantly higher than Wall Street. They see this at 108 over the next year, meaning upside of 38%. So when we run it through our own MOS calculation, what we're in turn saying is for KFO in today's episode, we see this at least a 35% MOS up to $82. At the 40% level, it would be around 76. So around 35 to 40%. If you do want us to do a deeper dive, we have covered it a few months ago, but happy to revisit it. Do give us your thoughts below and we can take a look. We then move on to Dow, which is trading at its 52-week low as of today's date. A triple hold across the board. This one is purely for those who love the dividend. We've included it today, over 6%, 6.22, around the same as Pfizer. Forward P around 21.2, down around 12% over the last 12 months. And when we look in terms of their expectations, well, 3 of the next 4 quarters, they are expecting large growth. However, out of the last 4, they have missed one of them, so 75% track record. But the key thing to understand here is earnings per share is expected to grow massively from the prior year in December 2025, which will in turn lower the forward PE to around 14.04. Now, in terms of dividend safety, borderline safe, we'll touch upon double undervaluation signal, and we are yet to see a dividend growth from this company in the shorter term. So what does borderline safe mean for this company? Well, reaffirmed last week, but as we have already mentioned for the others, moderate risk over a full economic cycle. And then when we take a look at essentially that dividend, what we can see is they have been paying a dividend for the last 4 years without a reduction, but they are yet to increase it. So in terms of this valuation model, when we zoom into the last 12 months, we actually see it now out of that tunnel. So that is that severe undervaluation signal. And when we compare it in terms of dividend yield theory, massive undervaluation, 6.29 above the 5.19, Forward P, not far off, 17 versus 16, although we do see it below the material sector P of 19.7. So let's talk about the free cash flow payout. Now we do want it below 40% for chemical producers. It's actually quite high in 23, and we would say this is a red flag indicator over the next 12 months, triple digit, so management are expected to pay out more in dividends than generate in free cash flow. So definitely something we would say to bear in mind, especially when we come to that margin of safety later on. Free cash flow per share, well, negative in 2017. It has increased since then, a little bit inconsistent, and we do have to flag over the next 12 months, this is expected to drop to around 243. Sales growth, we do get some negative in their top line. In fact, 2023, we see the negative 22%. And when we look at it from a numerical basis, we can see nonetheless, it is increasing, but inconsistency is a general theme with this company. In terms of shares outstanding, they have been doing some share buybacks over the period, but not enough that we would say is a priority from this management team. And then we move on to the ROIC. It does look good over the longer term in terms of being above 10%, but it is inconsistent, and we do get a drop from 22 to 23.7%. So again, there are some things to consider, even though this company does pay a very attractive yield. Now we also have to flag that inconsistency also comes through to the margins, both operating and free cash flow. And when we do look at the net debt to EBITDA, we want to see below 2.5. Right now on the trailing 12 month, it is straddling around that point. Over the next 12 months, expected to come down. So yes, this company pays a very nice yield. It is at a 52-week low, but there are some considerations, and we do understand this company will not fit every single investor's portfolio. In terms of our intrinsic value at $62.50, in terms of the MOS, well, 10%, a buy at 56, at 15%, pretty much around where the current trading price is now. So for Dow, you're getting a yield above 6%. In terms of Wall Street and their forecast, well, they see only 8% upside, one of the reasons why they did give this a hold. But as always, do give us your thoughts in the comments below. Now, we have talked about Pfizer continually on this channel just over the last few weeks, so we haven't included it. However, if we would have to choose, we do prefer Pfizer to Dow, but this is also an opportunity to understand whether or not this company fits into your overall portfolio, your investment thesis, and if you are happy with the margin of safety based on these metrics. We'll just show you before we do end the episode. At 20%, it would be about $25, at 25 at 47, and at 30 around 44. As we said though, 15% MOS, 8% upside. As always, do give us your thoughts below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter below, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.